Thanks for clicking! Look for the Federal Reserve to start printing money again when the president gets his rate cuts. This was the dominant theme on U.S. Bloomberg on Friday.
Yield curve control, maybe. Question of yield curve control, but
whether it's with yield curve control or...
Lisa nailed it. Yield curve control. Now,
and yeah, these anchors on U.S. Bloomberg were making really good points. Were the United States to move to yield curve control, as we'll see today, that would have major implications for the Canadian mortgage market. Here's Canadian Bloomberg.
And what's different about having a saltwater fish tank?
We're all fine, everyone's fine.
But US Bloomberg raises a good point, and it's similar to one that we've discussed before on this channel and can see at work right now with the bond market flashing warning signs. While President Trump has been pushing the Federal Reserve in any number of ways to cut interest rates, that doesn't necessarily mean longer-term rates, the rates that Canadians care about, as that's what dictates our fixed rates, to come down. To get those to come down, the Federal Reserve may indeed have to resort to printing money.
He's a very smart man.
So what I want to do today is go over what was said on US Bloomberg, take a look at how that money printing would play out in the United States, and then go over how that would affect the mortgage market here in Canada. Speaking of the mortgage market, the Bank of Canada is set to make its policy rate announcement in just a few weeks and have a press conference held thereafter, and we'll obviously have an update out on both on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, let's get into yield curve control. On to US Bloomberg, where the host, Jonathan Ferro, echoed what we've been saying so much on this channel, that there's a big difference between long and short-term interest rates.
The White House at the moment wants lower rates. That's the debate at the front end of the curve. They might well be upset when they find out that lower rates could lead to higher rates at the long end, and not given that loosening in the mortgage market that they are ultimately looking for.
So what Ferro was saying is that even if Trump does get his picks for the Fed, stacks the Federal Reserve with loyalists, and indeed does get his interest rate cuts, that doesn't necessarily mean that fixed rates are going to fall. In fact, fixed rates, those longer term rates, mortgage rates here in Canada, could in fact go up if the market thinks that the Federal Reserve/government is behaving irresponsibly. And to understand why, let's very briefly go over two ultra important points. First, that a bond's price and its yield are inverted. So say I loan the United States $100 at 3% interest, I'm going to receive $103 at maturity. I am yielding 3% on that bond. But say I want the money early, so I agree to sell my bond to Jen, who gives me $95 for that bond. I get that $95. Jen's still getting $103 at the end of the term, but she only paid $95. Jen is yielding 8.5%. So the price of that bond dropped and the yield went up. Second, expected inflation directly influences how much investors charge when they're lending money. What? If I think that inflation is going to be 3%, then I need to get more than 3% to lend out my money. I'm not going to lend my money out for free, or at worst, lose real purchasing power lending out that money, and as such, if inflation is going to be 4%, I'm going to charge at least 4.5% to lend that money out. So, the price of a bond and its yield are inverted, and inflation dictates interest rates. Now that we have those two out of the way, let's move on to the Federal Reserve, as the president has been adamant that the Federal Reserve cut interest rates.
If you're a dummy, then he's a moron. He's like a knucklehead. He's terrible. Numbskull. I'm a very stable genius.
But the problem, as outlined on Bloomberg, is that even if the Federal Reserve does cut interest rates by however much, that doesn't necessarily mean that fixed rates, that long-term rates, fall. The Fed has cut by 100 basis points since September, yet the yield on the 10-year Treasury is 60 basis points higher than it was when the Fed started cutting rates. And that's because, of course, the Federal Reserve only controls very short-term rates, whereas long-term rates, those 5, 10, 20, 30-year rates, those are dictated entirely by investors. Leading to the obvious question, if the Federal Reserve can't get long-term interest rates down via traditional methods, then what will? Well, first and foremost would be fiscal prudence.
Forget it.
Fair enough, but there are two other ways, which Ferro alludes to.
I just wonder if we're all underestimating the prospect of a new Fed chair getting aggressive with the balance sheet, and not just on interest rates.
Aggressive with the balance sheet. That's a fancy way of saying printing money, of which there are two different ways. The first being quantitative easing, which we are all well aware. Under quantitative easing, which we saw in 2020, the Federal Reserve bought up over $4 trillion worth of U.S. Treasuries and mortgages from the banks, which Canada did too, buying up around $400 billion over those 2 years, totally dwarfing anything else that had ever happened before.
Which is completely normal.
Yep, totally normal.
And what that did was add new buyers in the market for government and mortgage debt, with the United States committing to buying $120 billion worth of securities per month, meaning massively increasing the demand for treasuries. And Economics 101, when the demand for anything goes up but the supply remains relatively stable, the price of that thing is going to rise. Prices for those bonds went through the roof, yields went to the floor, and we all got very, very low fixed rate mortgages. The Bank of Canada did $5 billion per week, sending yields down. The average 5-year fixed in 2021 was 2.12. So, under quantitative easing, the central banks were just another player in the secondary debt market. That just adds the money printer in, bidding for the price of bonds just like everyone else. But what about yield curve control, the kind being talked about on Bloomberg?
They drop interest rates, and let's say Marvin's right and yields rise at the long end, and the White House starts to complain. What do you think the White House is going to want from an incoming Fed chair in that scenario?
Right, you get some form of yield curve control maybe. You get changes to the balance sheet, to your point.
Yeah, and unlike quantitative easing, the Federal Reserve under yield curve control would commit to achieving a certain yield. Whereas under QE, the Fed was just any number of players buying a predetermined number of bonds from the market every month or every week, under yield curve control, the Federal Reserve would buy as many bonds as they needed to get the price of those bonds high enough to get that yield low enough. Meaning they'll print as much money as they need to buy as many bonds as it takes to get the yield to where they want it.
Everyone's fine.
So if Trump or the Fed decides that they want 2% yields, they want the yield on that 10-year to be that low, the Federal Reserve commits to buying as many bonds as it would take to get there. And given that the Federal Reserve can in fact print money, they can print the world's reserve currency for now, it wouldn't be overly difficult for them to do so. And given that the yields on the Canadian 5-year run in near tandem to that of the US 10-year, that would put massively downward pressure on Canada's fixed mortgage rates. So those are the mechanics of yield curve control, that which is being talked about so much on US Bloomberg. But what's the likelihood?
I guarantee it.
Well, as we're all well aware, it's impossible to predict the future, especially when politics is interacting with economics. With that said, does anyone really believe that if Trump gets his picks for Fed chair, is able to stack the Federal Reserve with loyalists, after unprecedented attacks against the central bank, does anyone really believe that Trump gets his rate cuts, longer-term yields take off, as we've seen over the past 6 or so months, and then Trump just simply backs off? But look, Fed governors are dropping like flies, and Trump is going to get his selected Fed chair by next year, with many already thinking that chair will have a credibility problem. As such, I don't think it's completely out of the realm of possibility that the new Federal Reserve, post-Jerome Powell, will do whatever it needs to help Trump achieve what he wants, which is lower interest rates. Whether or not history plays out like this remains to be seen, but I do see yield curve control as a realistic possibility, unless that is the economic downturn is so bad that it causes inflation to fall far enough amid emergency level deficits in a non-emergency that the bond market gets to where Trump wants it on its own, sending interest rates lower.
See, we can't do this one of two ways.
And to the Canadian real estate industry and their stooges in the media, if you took the time to understand the global bond market, this would be the perfect opportunity for you to induce FOMO, as the lower mortgage rates caused by yield curve control in the United States has an actual chance of happening and is grounded in reality, unlike the majority of the other How this all plays out remains to be seen, but as always, as we've been talking about on this channel for so long, and as is becoming ever evident when we look at the housing market, the United States is where we need to be looking if we want to understand where real estate is going. We will obviously continue to track events unfolding in the United States and how it influences us here in Canada. Make sure you click like and subscribe if you want to get those updates. But for now, thanks so much for watching.